Hello, everybody out there. Here's again the boring lectures channel. Yes, okay, that went wrong already in the beginning, so that can only become a very nice and interesting session today. I think you didn't miss me in the meantime, but I missed you perhaps. And no, I didn't miss you. It just was a lie, but I thought it would be polite. So, what we have to deal with today is Chapter 2, beginning of General Introduction to Tax Law, and the topic of today will be the different kinds of taxes and the most basic elements of a tax system, so that you can have a certain first glance on what constitutes a tax system. Okay, so now here we are. So let's first begin where taxes are meant for. You know, taxes are meant for covering the need of the state for financial revenue, to cover the budget of the state, and to finance all the expenses the state has to make. Now, in principle, the state can obtain money from different revenues. One is naturally taxes. The second one is the state could own and run own enterprises, own businesses, and make profit from that and use that to finance its task. It may have reserve from former years, or it may obtain the necessary money by taking up credit from the citizens, which is then to be paid back in future years. Now, all these ways to finance the state budget have different advantages and disadvantages, ladies and gentlemen. Naturally, when you cover your need for money from taxes, that is something where your citizens will not be happy from, because they lose money and get nothing directly in return. So if you try to increase the tax revenue by increasing the tax rates or so, then your citizens will become angry, and if you live in a democracy, you will have to face some grave problems in the next election. By the way, already in times when there was no democracy, so in the times where kings and dukes and other people ruled relatively absolutely, so uncontrolled by others, even these had big problems in raising taxes, because that was usually the red line where their citizens turned to unrest. And there was then political disputes, quarrels, problems for the authorities if taxes were raised too much or too heavily. So taxes is a good means to finance the state, but political problems probably combined with it. The second alternative, state has own businesses, and these businesses bring profit, and state lives from that or finance the budget from that. That was something which was rather popular in the Middle Ages. For example, round about at 1200 or 1300 BC, no, AD, sorry, in Germany, when the emperor took over government, then it was usually expected that the emperor financed the state affairs from his own pocket. So you had to be privately rich, had to own some domains or some parts of land where you could obtain rent income, and then you could use that to finance the government's household or so. And only in very extraordinary circumstances you were permitted to ask the representatives of your subjects for a little financial help, kind of a subsidy, a donation which they granted to you, and that was the origin of later taxes. Well, this model, that sounds at the first moment very interesting. You have nothing to do with the state budget. State has own sources of income, profitable things. But if you look to that model a bit deeper, and you see it has some disadvantages. First, what happens if the state-run businesses make a loss or so, or don't run so well? Then the state will lose financial sources of its income. So what will the state probably do? Probably, as it is the state, they will begin to force you to buy their stuff, even if you don't want it. So in the end, we end up in something like state fabricates passports and forces you to buy them for a heavy price in order to be able to make the necessary profit. So the temptation is relatively high that the state businesses in the end get some help indirectly by the state because the state forces you to buy stuff there. Or another alternative, imagine you want to open up a business in the same sector where the state runs the business. That's probably not a good idea from the perspective of the state. So the state will either try to shield its businesses from competition by setting up a monopoly, or the state enterprises will fight your enterprise strongly in competition, or they will perhaps take refuge to unfair means. And imagine if you live in a state where the state not only lives from business revenue but also from taxes, then you can imagine your taxes, which you pay for your profit in your business, will be used to give money to the business, which then acts as a competitor to yourself. So the taxpayers who earn their money from business activities would indirectly finance their own competitors and finance their own ruin in the long run. That's not a healthy situation. That is why most states have refrained from that financing model in the meantime. And it's really a Middle Ages situation. So before taxes were invented, and it only works with areas of the economy where little or no competition can be expected. Usually in the Middle Ages, that was income from land. Good. Reserves from former years, okay, that's possible, but these reserves must then come from a source in former years. And so we end up again with either taxes or business profits. Let's narrow it down. Nowadays, that must be tax revenue, which is left over from former years. That's not so very frequent. Nowadays, it's very popular that you fill a gap between the money which the state needs and the revenue which is expected from taxes by borrowing that money from the citizens, promising them an interest for the credit, and then the state, after some years, will have to pay back these loans, and to pay the interest. So what does that mean? First, that means when the loans have to be paid back, then you would have to pay them back from tax revenue. And naturally, then you would have to pay back taxes, originally needed amount, plus interest. So credit financing is, in the long run, naturally more expensive for the taxpayers than an immediate financing by an increase of taxes now. But there is something else connected with that. Imagine a government is not courageous enough to raise taxes now in order to get all the money needed for this year's budget. Then probably the situation is not going to become better next year or the year after next year. So when it comes to repaying the loan, the temptation is high to finance the payback of the loan by taking up another loan. And naturally, as we still have a gap in the current budget, probably now you take up one credit to repay the old credit, plus a new credit to finance the excess financial needs of this year. So the amount of loan financing goes up constantly. Indeed, that happens in most developed countries. The loans always are piled up, they get more and more, and usually they are not paid back, only by money which is taken from new credits. So it's a kind of a snowball system, or a Ponzi scheme, as one would say in the Anglo-American area. Hmm? Um, in the end, it's rather immoral, or rather tricky, because by this way of financing the state expenditures, the state takes away money from people who do not currently need it. They give it away voluntarily. They know it will never be paid back. Only others will be asked to pay it back. It's a continuous stream of borrowing. Everybody who is rich and doesn't need money at the moment gives the money as a credit to the state, because there is perhaps no other investment opportunity that is declared as a safe and sound investment, although all the people involved know it will never be paid back apart from by other credits. So in the long run, if one seriously thinks about it, you have only three alternatives what will happen with that mass of credits which are taken up by the state. They either are paid back by future taxes. You don't need to expect that seriously, because if the state government now has no courage to increase the taxes for 100 euro additional amount of money needed, they will not have the courage to raise the taxes by 130 or 200 euro in 20 years to pay back the taxes plus the interest. So forget about that solution. That is not going to happen in real life, only in theory. Economists sometimes believe in things like that, but economists believe in many things, for example in the ceteris paribus clause, which also is nice for theoretical analysis, but can never be met in real life. Then you can pay back by future loans, so that's a Ponzi scheme. And with every Ponzi scheme, or snowball system as one would call it in Germany, in the end, there will be one moment of truth. When it comes out, it can never be paid back. So in the case of a private snowball system, that is then bankruptcy. In the case of a state, you will end up with state bankruptcy, and all the investors having given credits to the state will then end up with financial problems. If you look to history, that is indeed the traditional way how a state gets away with its debt. And it has a huge tradition. For example, in German history, sorry, I am from Germany, so I know a bit about that. Some bankers financed the election and the budget of Charles V, that emperor in whose empire the sun never went under, and the guy who conquered the Americas. And one of his bankers had the emperor as a guest, and he showed him what his debts were really worth, because he took a document where the emperor confirmed his obligation to pay back 1 million or so, and he just took it to make to heat the oven in front of the emperor, to show that is your credit payback obligation really worth. When it came to later decades or centuries, from time to time you can read in history books about a state bankruptcy, or there was a war, and after that war the state in question was gone, and silently nobody thought about that state's debts again. The people who had invested there had lost all their money. Well, Was a nice game. And when you are still in that game at the wrong moment of time, then you lose everything. That's like in the stock exchange sometimes. So it's probably not a very honest or sustainable way to finance a state budget if you take money from credit. So living from taxes is probably the most sustainable, honest, and clear way to finance the state budget. The other ways have their difficulties. So, in principle, how a state system should be run is that a state should prognosticate how much money am I going to need next year and how much taxes will I have to demand from my citizens. So, in theory, tax law should be flexible, and the rates, especially the percentage which you claim from certain objects for the state as a tax, should be set flexible according to what you need in a given year. Under democratical aspects, that would also be advantageous because then the voters would directly compare what the state expenditure costs them and what it's worth for them. By the present mechanism that an extra expenditure is financed by credit, the voters of today obtain the advantages of the expense which is made. For example, streets are built, universities are founded, and so on, but they have nothing to do with paying back the necessary amount. And so the burden and the advantage are separated from each other, which is not a healthy thing. Good. So, in theory, the best solution, I think, should be that revenue from taxes should not be given, but taxes should be flexibly arranged according to the need of the state. By the way, better not the other way around. You often have politicians who regard taxes as a given datum and then try to adapt the state expenditure to what comes in as revenue. That is not the best idea. It's clear you don't disturb your taxpayers by setting the tax rates higher or lower. But on the other hand, either you take in too small an amount of money to fulfill the tasks that the state should have, or you take in too much and then spend it freely for unnecessary things. So the responsibility of the state towards the taxpayer is best fulfilled if you really prognosticate I need a given amount of, let's say, 400 billion next year, and then I have to set the tax rates in my taxes in a way that I can obtain 400 billion so that my revenue covers my necessary expense. Now, revenue from taxes, that's evidently the best way to finance the state. And now you and I and everybody in the tax field lives from the phenomenon that there is never only one tax in a state. There are many. And now what beginners and even experts sometimes long for is, why do we have so many taxes? Isn't that rather unnecessary? Why can't they just torture us once, take a big slice, let's say, of our income, and then let us alone and in peace? Why do they plunder us with so many different taxes? Isn't that unnecessary? I told you something about the principles of taxation. A tax should be convenient and economical, so cheap. Now, if you have 10 different taxes, you have 10 times bureaucracy. Isn't it better to have only one tax? And there are reasons why there are so many taxes. Okay, one should not overdo it, but I will show you some reasons why there are so many taxes, or why not only one tax can be the good solution. But first, let us make ourselves familiar with the fact that we have different kinds of taxes. Can easily become several tens, 20s, or even 100 different taxes according to in which country you live, the number is indefinite. So you could have enormous amounts of small taxes and big taxes, and so you have the need to categorize them, to build up a system. Okay, and the most frequent and most convenient system is to group the taxes according to what is taxed. And here in that little chart, what you see here, you see the most frequent taxes are taxes on your income, that is the money which you get. Taxes on wealth, that is the property which you own at a given point of time. For example, a property tax or a wealth tax could work in a way that every citizen is asked to declare which amount of assets, property minus debts, net wealth you had on the 31st of December of the year, and then you have to pay, let's say, 0.5% of that amount as a wealth tax. That also is a nice idea. So here the money is taxed what you have at the moment. And you also find very frequently taxes on money which you spend, so on expense or on consume. Especially, for example, on certain luxury goods, you buy champagne. Yeah, that is an indicator that at the moment you have a bit of money too much because ordinary people drink water from the crane or buy a cheap beer. But you celebrate and have party with bottles and bottles of champagne. So evidently you can afford to waste money for unnecessary things. And so that was the idea behind that originally. Who has so much money that he or she can afford champagne, that person also can do a bit for the poor. So to give away a bit of that excessive amount of money to the poor, that means to the state, who isn't going to use it for the poor or for the state. No? You see the logic behind that. And so taxes on consume are also a very convincing and frequent idea. Sometimes we distinguish them further in taxes on certain goods or sometimes taxes on certain legal procedures. That also goes back to the Middle Ages or even earlier. Sometimes, for example, when you concluded a contract on something and you needed an attestation of the contract's authenticity, the state demanded a kind of a fee for ascertaining the authenticity of the document. And later, that developed into an obligation to obtain that certification. And even later, one didn't care about the authenticity anymore. The state said every time when, for example, you buy real estate, you have to pay a certain fee for us. And as that was then a fee without anything done in return, that fee developed over time into a genuine tax. So sometimes you have a tax on certain legal procedures. Good. Something which I added to the slide, which is usually not regarded as a genuine tax, but something similar, that is customs duties. Customs duties is an extra levy which is levied if goods come across a border. In theory, customs duties can be levied on exports and on imports. The most frequent variant is that they are levied on imported goods. So if you can try it out. For example, if you order something on eBay, which comes from China or Thailand or Australia, and then is delivered to you, if that has a higher value and it's not a trifle, then when that good crosses the border of the European Union, you or somebody else will be forced to pay a customs duty. So let's say 2% or 5% or 10%, maybe even 20%, depending on the good, on the value of that good as an extra tax for the permission to let this good come into the country. Once or twice when I ordered something on eBay and it came from China, which I didn't foresee at the time, then I didn't get my package directly into my mailbox, my house, but I had to travel to the customs office, the nearest local customs office, where I had to pay the customs duty for the good in the package, and only then I was handed over the package. So customs duties are an extra levy only levied on goods which cross a border. And I added that to the list, although it's traditionally not discussed in taxation, because at the moment when you look to Brexit and stuff like that, or negotiations about free trade agreements between several states, it's all about these customs duties and what is combined with them. And so it might be a good idea to keep in mind that these things also exist, that goods crossing a border often are subjected to an extra kind of tax, and that this poses all the problems where the Brexit discussions were about. And yeah, that should be sufficient in the beginning. By the way, customs duties in English are called customs duties because in the English tradition, the king could only levy a tax with the permission of Parliament. That has not changed, by the way. Even today in Great Britain, the government asks Parliament every year for consent if it is allowed to levy an income tax for next year. But according to old tradition, so to the customs of the land, the King of England had the right to levy customs duties on goods coming from abroad. For this, he or she didn't need the consent of Parliament. And so, in the English legal system, that is why they called it the customary duties, or the duties which by custom the king can claim without asking for permission. So that explains that technical term in England. And other countries use other words. For example, the German term Zölle has nothing to do with customs duty, so you can't translate literally. Everybody has different terminology here. Good. What you also can distinguish when it comes to taxes is you can distinguish taxes according to the technique how they are collected. So who gets the obligation to pay them? Here we distinguish between direct taxes and indirect taxes. And now, surprise, the direct taxes are directly claimed from the person whom you want to, well, let's call it plunder. So who is meant to bear the financial burden in the end? For example, when the state wants to tax your income, you have to hand in an income tax declaration, and the state sends you a letter. You owe us, let's say, 20,000 euro for income tax of last year because we assess your income according to your tax declaration, and this is what comes out. Now, there are taxes where you are meant to be taxed, but where nobody bothers to ask you. For example, you know that consume is taxed in Germany with a general tax, the value-added tax, usually 19% at the moment of everything which is sold, and or 7% for some other goods. There is a reduced rate. So every person who consumes goods shall be taxed with 19 or 7% on the expenditure. Now it's rather inconvenient to ask private persons what they spend for consume. it's far too bureaucratic. And so the state has taken refuge to a highly more simple system, namely, they come to the idea, hey, the consume expenditure of the people is the turnover, the revenue for the business people. So we can just replace the tax on the consume expense by a tax on the revenue of the business owners, and can say every business owner has to declare the business revenue, and we take 19% of that as a tax. Now the business owners will then react if they know that if they demand 100 euro, they have to pass on 90% to the state. Well, what will they do? If they really want to keep 100, they are going to increase the prices accordingly, and then everybody will make you a price of 119 if he or she wants to keep 100. So indirectly, you pay the tax via the higher prices. And that is even built into the plan of the legislator that is meant to work this way. So that is why these taxes on consume usually are called indirect taxes. The person who is obliged to pay them to the state, here the business owners, are expected by the plan of the law to increase their prices accordingly and shift over the financial burden of the tax via the higher prices to others. And so these other persons, here the consumers, are meant to end up with the financial burden, although the taxpayers, here the business owners, are different. That is why you are only indirectly taxed. Under a political aspect, by the way, such indirect taxes are often very convenient because the business owners, if you push up the tax rate, think, well, in reality, not absolutely my problem. I am to increase my prices accordingly, and everybody else will do so too, so it does no damage. And the customers will just see the prices have gone up and will not realize completely that this is due to a rise in the tax. So the opposition, which might arise if you rise the tax rate, is probably not so high as if you increase the direct taxes. People don't feel the indirect taxes so clearly in their life. Good. Okay, let's keep that in mind. A direct taxation or a direct tax means the tax is collected from that person who is also meant by the plan of the legislator to bear the financial burden in the end. Whereas indirect taxation is characterized by the tax is collected from a person who is not identical to the person who in the end is planned to end up with the fiscal burden. So, good. Examples for indirect taxes would be value-added tax or taxes on tobacco, taxes on mineral oil, taxes on beer, taxes on champagne, taxes on tea and coffee. Indeed, very often such taxes have been invented for everything which could have been seen as a luxurious good. And if you ask somebody in a fiscal ministry what is luxury, you will be surprised what is evidently all a luxury. Coffee. Yes, 300 years ago, coffee was a luxury product because it came from far away. And once you invented a special tax on coffee, naturally, why should you abolish it? People have become used to that. So many taxes have been introduced in the beginning on something which was luxury, and later they were abolished nearly never. For example, in Germany, there was even a tax on bulbs for electric light, because when that was invented 150 years or 200 years ago, that was the ultimate luxury. electric light instead of candles, no risk that your home burns down from the candle which falls aside, no smoke in your rooms. That was highest potential luxury at the beginning. That tax was later abolished 150 years later or so, or 100 years later in, I believe, 1992, because at the time the tax on light bulbs was no longer important financially, and they regarded it as too complicated to keep it up in the single market of the EU and complicate competition by that. But that was nearly a very lucky event, and that's very rarely happening. So if you want to make yourself a bit competent in your own tax system, take a textbook or look through reliable sources in the internet and try to find out which kind of indirect taxes exist in your own home country. How are they called? What is taxed there? That's highly interesting. And then you get a feeling what, for example, your own legislator probably all regards as a taxable good or what they regard as potential luxury. Especially easy should be to find out which taxes can be found in the UK and USA, because our studying language is English, and so you should be able, at least in the long run, to study and obtain English texts on English and American tax law, and so to dig yourself a bit into the matter there. Good. But this is not the only way to distinguish taxes. So first, according to the object tax, second, according to the technology, which is used direct or indirect taxation. There is also another criterion where you can distinguish taxes, and namely according to who gets revenue from the taxes. That's rather more a distinction which is interesting for the people in the tax administration, but nevertheless you should know that such a distinction exists. For example, in Germany, there are certain taxes and levies which go to the European Union. For example, the customs duties revenue goes to the EU, and the German officers at the border collecting that customs duty can only keep a certain amount which covers the cost of the administration. All the rest goes to the EU. Then we have taxes levied by the Federation, where the revenue goes exclusively to the Federation. Usually the taxes on consume end up there, with one exception, the beer tax, which when Germany was refounded in 1949 was explicitly reserved to the Länder on explicit demand by Bavaria. The Land of Bavaria insisted we only accept the Constitution of the Federal Republic of Germany if the beer tax is retained for the Land of Bavaria or for the other Länder. Standard reputation of Germans is drinking beer and celebrating Oktoberfest. Evidently that played a role in the minds of the politicians in 1949. Good. Then you have combined taxes or shared taxes. That is in Germany called Gemeinschaftssteuern, so where the federation sets up a tax, but the revenue is shared between the different levels of the federation. So if you think of value-added tax, income tax, or corporation tax, then the usual solution is that the revenue from these taxes is shared according to a pre-arranged or previously agreed percentage to the individual levels of the federation. So a big slice of the revenue goes to the federation, another slice of the revenue goes to the German Länder, and a bit of the revenue from the shared taxes also goes to the cities. Then certain taxes go to the states exclusively, so to the German Länder. For example, if you die, the inheritance tax revenue goes to the land where you had your residence in. And there are some taxes which can be invented by the municipalities, that is, by the cities. For example, the dog tax, the famous one, which I already mentioned, or a tax on the people who have a second home in the area of a city very often are subjected to a second home tax or second habitation tax. Many cities also levy a certain surcharge on or a tax on the amount which you spend for an overnight stay in a hotel. So there are several small little unimportant taxes possible. You remember that I told you that in the German Federation, every body who can legislate also has a right to invent taxes. Only with one restriction: a lower level cannot levy a tax on an object which is already taxed by a higher level. And as the Federation is relatively greedy, you find very, very few occasions which you still can tax if you are a city. So most of your revenue comes from the share taxes and from the trade tax, which also goes to the cities. Yeah. You can also debate which institution, or distinguish taxes, which institution collects them. So where the work is done by, federal taxes are collected by the customs authorities, and the shared taxes and the taxes going to the Länder, to the German Federation states, are administered by authorities who belong to the administration of the German Länder. So if you have to pay income tax, all the work is done by your local fiscal office, and that local fiscal office is not directly subjected to the Ministry of Finance of the Federation, but it will be subjected to the Minister of Fiscal Affairs of the land of North Rhine-Westphalia, or of the land of Bavaria, or wherever you live. For people not working in the administration, that is usually nothing which they really have to bother about. Good. Naturally, you should also open your eyes up a bit and do some research to make yourself a bit competent in the rules of your own home country. Who gets the tax revenue in your home country? Is there also a mechanism how a city is financed? Do they all get their revenue only from the central institutions, or do they have a right to an own tax as a source of own revenue where they can decide upon on their own? Well, try to find that out, or which categories of taxes exist in your country. I think that might be an interesting thing. Good. Now, if you take a closer look to a tax system, then we come also to some important definitions. For example, by definition, the amount of tax is the product of the tax base, so the thing which is taxed, times or multiplied by the tax rate, which is usually a percentage of that tax base. For example, you can imagine that if you have income from capital in Germany of, let's say, 100,000, then the tax rate on that income from capital will be 25%. So the amount of tax you will have to pay will be 25,000. 100,000, the tax base times the tax rate. This is rather trivial. No problem, you should only know the words. No? Good. Sometimes you hear not that there is a tax rate, but people then speak of a tax tariff. A tax tariff is something special that is a set of tax rates. So you don't have only one tax rate, you have a long list or even a formula of tax rates which apply to several situations. The most complicated and horrible example of tax tariff is a customs tariff. because there you have a long list which kind of good is taxed with which percentage or which fixed amount. So if you work for the customs authorities, you spend your life in looking into packages, find out what you find inside, think about what is it, which category of good, turning 1000 pages to and from, and then finding the right category and applying the tax rate which is in that list for that category of goods. So a tax tariff is a long list, or a set in the mathematical way to express it, a set of tax rates. The income tax usually also knows not one single tax rate, but different tax rates for different persons. So one also speaks in the area of income tax of a tax rate for the individual case. But if you speak of all the tax rates together, you would say, I speak of the income tax tariff for 2020. Good. Furthermore, it's clear you should know some important technical terms. The taxpayer is the person who is legally obliged to pay the tax. So keep in mind, when we had these indirect taxes, they want that the tax is in the end financed by the consumer, but the taxpayer was the business owner, because the business owner is a person who has to hand in the tax declaration about all his revenue, and the fiscal authorities will go and ask him or her for the tax amount. So if you buy something in a shop, legally, the value-added tax is no obligation of yours. You are not the taxpayer. On the other hand, when it comes to income tax, then you have to hand in an income tax declaration at the end of the year, and one will directly address you with a tax notice and collect money from you. And if you don't pay, then somebody from the fiscal administration will some months later ring the bell at your door and say, hello, fiscal office sends me. I have heard that you have some problems with understanding the term you have to pay. I have been sent to teach you how paying is done. Let's begin and confiscate all your property until it is enough to cover your tax. So that only happens to a taxpayer, somebody who is legally obliged to pay the tax. If somebody else is taxpayer, then taxes are always nice because they can never become your problem. You are not the taxpayer, so not your problem. Tax consultants, or also called tax advisors, either written with an E or an O, at the end are the persons who help the taxpayers to fulfill their fiscal obligations. As you will see, tax laws can get a bit complicated. And so professions have specialized on helping people dealing with tax laws, and that are tax consultants or tax advisors. The important thing, by the way, is that in many countries, as the tax law is so difficult, not everybody is allowed to act as a tax consultant professionally. For example, in Germany, a tax consultant or tax advisor, a Steuerberater, can only be somebody who passed a longer preparation period, for example, study of taxation or studying business, plus 3 years or 2 years work in a tax firm as an employee. And then you have to pass a state exam before you get the permission to act as a tax consultant and use the title of tax consultant. So what you as beginners already should know, whenever somebody says, you study taxation, help me with my tax declaration, then that would bring grave problems for you, because the legislator here in Germany wants to shield, to protect the people from the damage which could be inflicted, because everybody always thinks, I know with I know all about taxes, so let me help you. Give me 100 euro, and I'm helping you. And in the end, the person who trusted you ends up in prison because, well, your tax knowledge was not very perfect. And to prevent this from the beginning onwards, there is a strict rule that nobody who is not accepted after a state exam as an official tax advisor has the right to give advice to others. So if somebody asks you, run away, stay silent, never give them advice, hand them on to a registered tax advisor, or if somebody asks you, then speak just theoretically and tell them, okay, I cannot solve your case. For that, you must go to a tax advisor. A tax officer would be somebody who works for the fiscal office, that seems clear, and the tax office or fiscal office will be our denomination for that public authority which deals with the tax case and is part of the fiscal authorities. So usually in Germany that would be called the Finanzamt. Sometimes the Finanzamt, so the local tax authority, will be supervised by higher authorities. Usually you have that in a well-developed administration because it might always be that a civil servant, so a tax officer begins to work not properly, so you will have to have an authority which supervises that everything in your local fiscal office is done properly. And so we also have in the German administration superior tax authorities, which would be called in German Oberfinanzdirektion. So the higher fiscal supervisory institution or authority. That is, for example, in complicated cases, your local fiscal officer will ask the superior tax authority, the Oberfinanzdirektion, for instructions how to deal with such a case. And the idea behind that system is if complicated cases show up which are new, we still want to guarantee that equal situations are treated equally. So if somebody sees, new and complicated situation, I have not yet any instructions from the ministry, then I pass on the case to a superior authority because they might have come across a comparable case somewhere else in their area already, and so they can coordinate our behavior in a way that equal situations are treated equally so that fairness is granted in the maximum possible extent. Good. Above all these people, we have then still the Ministry of Fiscal Affairs or Ministry of Finance, in German Bundesfinanzministerium. They coordinate the work of all these authorities and sometimes give central instructions in form of circular, in form of letters which are sent round, so a circular with instructions, or even by similar things called rulings or administrative directives, which say everybody working for us in the fiscal administration has to stick to the following opinion on the law, or has to deal with cases according to these instructions, again with the aim to secure that equal situations are treated equally. Good. We have already heard about the fiscal court system. You have local fiscal courts. You can't select the court to which you appeal. There is only one court responsible for the area in which you live or for the Finanzamt from which you got the tax notice. So if you want to object against the tax notice, you must object at the fiscal office which issued that tax notice, and then the fiscal office will inform you which fiscal court will be competent or responsible to decide upon a lawsuit if you want to begin one. And in the end, we already mentioned that you have the right, because humans can make errors, you have the right that the correctness of the fiscal court decision can be reviewed by the Federal Fiscal Court in Munich. And the decisions of that Federal Fiscal Court are usually published so that you can see which arguments convince the highest fiscal court in Germany and which arguments are rejected. That is highly interesting, because then you can draw conclusions for similar cases. By the way, that is also done by most other high courts, which I know, that in at least an anonymous way, not naming the persons involved or so, but that at least the material aspects of every important case which they decide are published with the full reasoning of the court on what the taxpayer wanted, what the fiscal administration said, so that you can form an opinion with which arguments you can be heard and which arguments will be rejected. That can really be a treasure for you and me to get up to date. First, you see what are really the cases where quarrels and disputes come up. And second, you see how a court thinks about the way how people think and argue. For example, what's really recommendable to boost your knowledge of law is reading the court decisions of the European Court of Justice. These decisions have the big advantage that they also are obtainable in English, and so you can easily read them. You can read them, by the way, in every official language of the European Union. So if you come from Sweden, you can, for example, have a look into the English version and then switch to the Swedish version and compare. It's exactly the same contents. So that helps you greatly in getting familiar with what's going on in the economy and in the field of fiscal affairs. Good. The next thing what we have to talk about is then when we make our tax system a bit more concrete, which things are we going to tax? So what are good tax objects? And then what can we say about the tax rates? So according to which logic should we decide about if we take 5%, 20%, 50%, 80%? This should be reserved for the next video, so make a small break, enjoy a bit of free time, and then come back and look into the second video of chapter 2, because there you will be informed about all these things going on here. Good. That shall be enough for today, or for this time. See you back soon for the second half of this chapter. Thank you very much for attending. Till next